Thanks very much, Sam. I hope you don't mind. I'll stand up because I'm so small I'll probably just fade away into the chair. So I'd like to talk to you today about third-party risk management. It is a topic that's near and dear to my heart. And as you heard, I was Chief Procurement Officer in 3 major banks. In fact, 4 times in 3 major banks. I went back to one after a 12-year absence. And so what this has allowed me to do is you're going to find that anybody in third-party risk management will have come from this discipline from many, many different places. So I did come from the procurement stream. And one of the reasons why that makes sense in a financial institution is when you have a procurement organization, it's extremely common in the larger banks that the third-party risk management program is a part of the procurement organization. And the separation of duties is then your operational risk management, provides the oversight and governance for the activities in the program. But it's a pretty normal thing to do. So I've had great good fortune also. Last year, if you ever get a chance to do this, I don't know if you've ever wanted to write a book, but I really have wanted to write a book for more than 10 years. And so last year, at the beginning of the year, I was asked by Risk Management Association if I write a book on third-party risk management. You probably have noticed there's not a whole lot out there besides things that you read over and over again about, sort of, well, you have to do this and you have to do that. So I thought it'd be kind of a nice idea to step back and think about the context, not the what you have to do, but really a more broad view of things around, why are these regulations in place? Why are we doing the things that we're doing? And what's the context for that? So it's a guide that's written for many different levels in an organization, right up to the board. I was very flattered. I know that there's the risk committee of one of the fintechs, actually, their entire risk committee has read the book. And the reason for that is it provides context for risk management, particularly third-party risk management. So I was one of the lucky ones. I took a 6-month sabbatical, and I thought I knew a lot about third-party risk management until I sat down and wrote the book and started doing a ton of research. So if you ever get a chance to write a book, it's a good way to really crystallize what you already know and help you think about the things that you know not as well as you'd like to. So that really led to a nice other opportunity, and I now teach at Wharton in their advanced risk management program. I'm not allowed to call myself faculty, but I'm one of their industry experts, and I come in and talk with them about third-party risk in their program. So there's a lot of good things to get involved with out there, and if you're not involved with any of them today and you're interested in third-party risk, you're at this conference, there's lots of different things you can belong to, because this is a journey, and we're really not very far down the road yet. So I do come from the financial services sector, so if you know the history, there's regulations that have been in place for quite some time, but after the financial crisis in 2008, there was a real push on to improve the programs in the financial services sector, because the regulators observed during the financial crisis that some of these critical vendors or third-party relationships could have brought down the whole sector, not just individual institutions, and that really piqued their interest. And so in 2013, there was a lot of new guidance that was written. So if you're not in the sector, I would still encourage you to read the guidance, because it is well written, it's very thoughtful, and it gives you a guide to how you might frame your own thinking around effective third-party risk management. So there's no doubt that the financial services sector invested in third-party risk management because of the regulatory pressure. So if you're in a bank or an insurance company, you get a matter requiring attention, which is a very bad news message from a regulator. And so there were a ton of them. And what we're seeing now, because I'm the Risk Management Association subject matter expert and I run the roundtable for them, I also help with the surveys. So we go out to the sector once a year and we ask them what's happening. So we see from the 2017 sector that the amount of criticism is declining. And I would say that when we run the roundtable, there's not a lot of banks that are sitting there up to their eyeballs in MRAs that they're trying to clear. But basically what they're seeing is that, it starts with the big guys and it kind of migrates downstream. And interestingly enough, if you're looking for a colleague to talk to, the mid-tier banks, the ones that are basically sort of around the 100 to 250 billion mark, maybe even as low as 50 billion to 250, they actually are the best at this. And you think about why would that be? And it's because they have the resources to be able to invest, but also they have a small enough population that they can wrap their arms around it. So they've done actually probably a better job in the long run of actually putting the program in place and running it and starting to add value through it. the largest of the FIs, the JP Morgans and the B of A's, it is such a hard task. They're just such behemoths, it's very hard. And the community banks, basically, you're seeing there's more criticism because, of course, in any law or regulation, they always start with the big guys and they work downstream. I mean, I'm just waiting for that first big fine in GDPR to see who it's going to be, and it's going to be one of the big guys. We already know that that's where they start. So what I think is kind of interesting is these programs were built with a compliance lens, a regulatory compliance lens. And really where you need to go with these, especially if you're new in this, is try and get by that fairly quickly and think about enterprise value. Because there is a dawning awareness in many, many companies, not just financial institutions who had to do this or healthcare who has to do it, but in many different sectors we're finding that there's a huge amount of value for the enterprise, and that's what I really want to talk to you about today. Because if we spend a lot of time on the how-tos, we'll never get to really the sales pitch and the value proposition for your company. So the value proposition for the business, I think that's probably where you start, is actually a business leader. And if you're out there trying to convince your organization that they need to pay more attention to this or that they should invest in the first place, what you may want to consider is, what's the message back to the business? Why would they want to do this with all the things that they have ahead of them in terms of, opportunities to spend their time and their money? So I think that third-party risk management, like any other form of risk management, is in fact all about prevent, detect, and respond. So if you look at the whole ecosystem that you work in, your company's just one cog in the wheel. So that means that the business is also working in a complex ecosystem. And because I've been a senior executive and a lot of these people were my peers, it's a different conversation. I think a lot of times you go in at a lower level thinking, well, you have to give them all this data. But I think if you think about how they can best run their business to avoid the preventable and to be able to respond quickly when there's a problem, that's really what makes the difference to a senior executive who's running a large business area or group head. So it's a very compelling value proposition. So you need to think ahead around what kind of information could you bring them, and how are you going to do that, which would allow them to understand this value proposition. So I think the biggest thing is that it allows for informed decision making. Above all else, it's a type of information that you would take forward that doesn't say, well, you have to do this because there's a regulation, or here's a program or a policy, you must comply with it. But you're running a business and you deal with a lot of third parties that you couldn't operate without them. So we already know it's a complex ecosystem, but wouldn't it be better if you had all the right information so you can make informed decisions? Now, another thing is that spend is not a risk. If anybody tells you it is, that's probably because they're new to this. But the value for money concept actually makes a big difference, because if you get into a relationship, what I concluded when I was writing the book, that you just have to get into the right relationships in the first place. Because if you don't, you're going to end up paying and paying and paying. So when you think about value for money, it's not just the services that they're delivering or the products that you can resell to your customers. It really is the value that they're bringing to your organization on multiple dimensions. They can help you manage risk, or they can bring more to you. They can help you manage your processes, or they can make it more complicated. And then they can bring innovation, or not. So it's a value for money proposition as well. So on the respond side, one of the things, and I think I mentioned this yesterday in the workshop, but after WannaCry, which was the first of its type in the wild, I contacted 3 heads of third-party risk management that I know well enough to ask the question of. And I looked at 3 in different levels of maturity. So where there was a very mature program, I waited about 3 weeks. I said, hey, WannaCry, what did you do? How fast did it take you to get on? How fast did you get on top of it? And the answer for the first one was 48 hours. It would have been shorter, but I didn't realize that my cell phone had run out of juice. So that's a good news story. And on the far side of it, basically 3 weeks later, one of the institutions with a very new and very immature program said that they were still working on it 3 weeks later. So it's a prevent and detect, but it's also a response system that you're putting in place, because bad things happen. And we already know from all the news that if you have a good news story about what you're doing to manage risk, you can probably sustain the reputation hit that you're going to get if there's a breach or there's some other serious interruption of service. So what I'm really trying to say here is, if you're talking to the business, or if you're talking to your executive, whether or not they want to adopt the program, or they want to invest in it, or they want to invest in the people and the systems, there's a good value proposition story here that you can tell. And if you step away from that, I think you're going to be a compliance program, and it's going to be talk to the hand, or it'll just be bare minimum. So I also think you need to consider the senior leadership of your organization, because now, when you talk to the business, you can get in that level of granularity around what you're bringing to them. But when I was running the book, I had the good fortune to work for Greg when I was with Fifth Third, and he was not the CEO at the time, but he is now. And I asked him if I could interview him for my chapter on building a strong risk culture. And this is a quote that I took from him that I published in the book. But senior leadership needs to have this mindset. They need to think about risk, not just during the bad times, but during the good times, so they can prepare for the times ahead. And I think that if you are in an organization where your executive management and your board think along these lines, which they surely do, I would say most companies do, there's a message that you can have in there about how you're helping to protect the company in the bad times and strengthen it for the days ahead. So this all rolls up into what's known as tone at the top. And tone at the top is just a phrase for the risk culture in your organization. It's set at the highest level by your board of directors. Your board of directors does actually set the strategic direction for your organization. And in fact, they're the only group in the whole ecosystem who's actually personally liable for the decisions and the actions of the company, and which is another good reason why they want to be involved in this and understand how your third parties are actually helping you deliver services, and in fact, how they're strengthening your company, or in fact, weakening it through the risks that are coming in. So you want to make sure that when you are developing a program, you think about really the people who you are most responsible for. And that's not the business partners that you have in other parts of the business, your CIO or your head of HR. It really is the executive team of the company where you work, because they are your stakeholders. They're representing your board and your shareholders and your customers. So one of the things that I got from Greg is that they have a program called North Star. And what they've done is embedded a risk component into every major initiative that they're undertaking, so that they don't find themselves getting down a path that allows them to take on more risk than they intended. And in fact, to go one step further, they've actually exited some profitable businesses because they felt that the third-party risk was a risk that they're unwilling to take. So one of the areas that I know that in the financial services sector that they're looking at is indirect lending. Because indirect lending, whether it's auto lenders or mortgage brokers, et cetera, they're out there representing your company, and you have almost no control over them. And I've had many companies talk to me and say, gosh, I have tens of thousands of them, of individuals out there, and that's a very hard thing to control. So if your company is really looking at the businesses it's in and where it makes its revenue, there needs to be a risk component that's considered. Now, I think that at the enterprise level, when you start to think about how do you put this all together, right? Because you got a bunch of activities that you're doing, and you're trying to serve many masters in doing this. But when you step back and say, if you're doing a great job for your company, what might this look like? So number one, I think you have to have engaged employees. They have to have the cognitive and behavioral skills that really are conducive to good risk management practices. But then you really need to put in the heart of the conversation, well, what is our corporate strategy? How does this align with the tone at the top and our risk appetite? And these things will lead to a much stronger brand, happier customers, and happier shareholders. So let's talk a little bit about how to get there. So I like this quote. I mean, this is Warren Buffett. Risk comes from not knowing what you're doing. And my favorite version of that is, any road will take you there if you don't know where you're going. Right? So you want to figure out what your road is to value as opposed to your road to compliance, because compliance will come if you do the right things. So I also thought we should just touch for a moment on what is meant by a third party, because I think there's some confusion out there. So to my mind, basically, third parties we already know it includes vendors, like that's a given. And whether or not you have any other way to find them, you can always find them by doing an inventory of your accounts payable system. Because if you pay a bill to them, then they're a vendor, whether it's accounts payable or through your P card or whatever. They're actually, even though they're huge volumes, they're easy to find, and you can bring them in the program. What's a little bit more difficult, or a lot more difficult, are the other types of third parties. What we're calling, for the purposes of this conversation, is these non-vendors. And what you're going to find is they are acquired centrally, and there is very often no direct payment that comes out of your accounts payable system. You may have a joint venture. You may take a portion of a premium that they've collected. They may be a brand partner. There's many, many examples. And if you're in the financial services sector, we actually took the time to do an inventory. We got 11 companies who contributed, and we organized it up into 19 categories and 53 subcategories. So this is actually bigger than your vendor population for most companies in this room. And you may or may not have them in there. But third parties are third parties are third parties. If they're not a customer, they're a third party. And a third party is contributing to the operations of your company as well as the risk. So we're finding there's a lot of similarities. I mean, you can have one policy, a lot of your risk identification and controls can apply to these other types. But you're going to find that the governance of those, there is no one size fits all, and you're going to have to get out into the business to find out how they're governing these relationships, and so you can provide the oversight to their management activities and their monitoring activities. So the way to do that basically is, in order to put all the pieces together, you have to have two things. One is really a lifecycle management framework. And a lifecycle management framework is simply all the, well, simply, because there's a lot. It's the tasks and activities that you would design, and the methodologies that underlie it, and the processes that go with it, and the technologies that allow you to go from a business concept that they'd like to have a third-party relationship all the way through the life cycle to a termination. And so you need to think about this fairly deliberately. And I think if you're struggling in your organization, add a visual to what you're doing, because it's a lot easier to explain to people. Because when you show them a simple lifecycle management framework, and they go, "Oh yeah, I get this," right? So, but it is codependent on your governance and oversight, which goes hand in hand. And this is where I find people actually don't put it down on paper, and they don't explain what the controls are for the overall activities. So it starts with your senior management board of directors, as we talked about. There should be a risk management framework in your organization. If there's not, then you can look on COSO, which is the Treadway Commission. There's lots of good examples, and it's usually just 5 types of risk, strategic, operational, financial, reputational, or some shorter version of that. So if you don't have a risk management framework, at least propose one. And we are finding that more and more, because there's so much activity in third-party risk management, there's a governance and oversight committee that's put in place in many, many companies. And I would suggest that you do this, because if you're building, it gives you a place to go and get some feedback on what you're doing and give you a little bit of air cover. And then when you're running full bore, there's always things that are coming up, and you're going to have to meet with them on a regular basis to keep them apprised of what's happening in the organization and where you might have challenges or where you need their opinion. So they need to be pretty senior people. I would recommend that they would be sort of no more than 1 or 2 away from your CEO, because they have to be powerful enough to feel comfortable challenging their peers, even if it's safety in numbers. And then, so the rest of your framework is all the things that we've talked about, but you have to document them, right? Your policies, how they link to other policies. Usually you're cross-referencing at least another 5 to 10 policies at least. And then you've got all of your controls. You have a great number of the controls today, I must admit, are contract controls, so you figure out what you need and want, and then you contract for it. But there's also controls in the business, especially compensating controls, if in fact the controls in the third party are not what you would expect them to be. So, for example, a compensating control that's actually regulated in the financial services sector is putting a contingency plan in place for your critical third parties, because that's not their plan, that's your plan. What are you going to do if there's a major failure? So there's also the issues in incident management. How does escalation work? And one of the best quivers in your arrows in your quiver is the effective challenge, and that's the right and the responsibility to challenge undue risk taking in the organization. But when you do that, make sure that you've got an escalation path, because these are not things that you can resolve on your own, and they often go up to very, very senior levels for a resolution. Because you can't agree to take on undue risk if you're responsible for third-party risk management. But what you can do is agree to escalate it for decision-making at a higher level. And that basically, I found, it's a comfortable place for most people to be if they're in a third-party risk management role, because then they don't have to feel uncomfortable challenging a senior executive or an executive in a business area. They'll just say, hey, listen, I can't agree to that. That's outside of my mandate. And so if you'd like to pursue this, here's the reasons why it's going to have to get escalated for a higher level decision. So, and then of course, I don't think you can, I know this is a MetricStream conference, you cannot do this without technology, Because what technology does for you is help manage your workflow. You get a document repository. It can do auto calculations. It can bring in data from other sources. It's going to help with reporting. And if you try to do that without technology, I really do think that you're going to find all of your work is in task management, and you won't be able to keep up, but nor will you be able to manage risk because you'll be too busy. So then when you think about, well, what are all the risks? And there's many, many of them. And the reason why, I know not everybody at this conference, in fact, there's not, only a percentage is from the financial services sector, but I talk about what I know the best. There's some really good cross-references here for different types of risks and how to think about it. So business continuity management, there is a cross-functional set of regulators that put together guidance called the FFIEC, the Financial something or other, whatever, committee, council. So they've published this Appendix J about 2 years ago, and that helps you understand what you must think about for resilient companies that you're doing business with. So it talks about testing, it talks about business resilience, it talks about disaster recovery. So it's a really good reference. The Appendix C is thinking about how you would evaluate and control the risks of dealing with organizations that may operate in different legal environments, they're in a different country, or have different norms. So there's a whole appendix on that. And then if you happen to have any questions about how you want to evaluate cyber, there's a tool that was only put out, sometime in the past year by the FFIEC called this CAT, this Cyber Assessment Tool. And so they don't expect you to use it if you're in the sector, but it's a really great guide to knowing the types of things that you should be looking at in terms of cyber. And of course, privacy, GLBA. I did speak earlier, and Sam, when he introduced me, talked about the shared assessments group and this shared information gathering tool. So I'm on their advisory board because I'm what you call a net promoter. That's how I ended up there. But it's a great tool. It was, it's been around for about 15 years, and it is, it is crowdsourced by experts. So it is kept current all the time, and there's all these work streams that happen all the time, keeping this stuff current and up to date. And what I like about it is you can license the content, and you can use the pieces that make sense to you, because there are 1,300 questions in there, and you may not want to use all 1,300. In fact, most companies don't. But what I find is, especially if you're earlier days building your program, it's entirely defensible, because it's been developed by experts. It's mapped to NIST and to ISO standards for information security, privacy, physical security, etc. And then you don't have to argue with people about the content. So I was talking with CISO last week in one of my client groups they're not quite there, and their tools aren't strong enough. And he told me that every time he tries to administer an information security assessment for a third party, then he gets challenged by the business. Why do you need to know that? Shouldn't you ask this question this way instead of that way? And so it's really distracting for him, and he can't get on with the business of doing his job because he's fighting them on the questions. So I think, that's why you would want to adopt these things, because if they're in standard industry practice, use what's already out there and then adapt it for your own purposes. So if you need to slightly change the words, so what? Go ahead. If you need to add another question, go ahead. But basically, with 1,300 questions, you can bet your boots that they have covered a lot of territory, and you don't have to make this stuff up yourself. One of the things that I would like to draw to your attention is model risk. It's a new type of risk, and if you were in the general session earlier where they're talking about AI, or some of the sessions talking about AI, NLP, neural learning programs, learning machines, etc. I knew I didn't know enough about model risk when I was writing the book. So that was one of the first things I did. I read Cathy O'Neill's book, Weapons of Math Destruction. And I read another one, I can't remember his name, but it's Models Behaving Badly. So the first one is a very easy read, like a couple hours. The second one is a technical book on model risk. But it gave me some real perspective on model risk and helped me understand where it comes from. Where do models come from? Where do algorithms come from? And basically, models and algorithms are always built on historical data. And you have many choices of data, and the data integrity may be questionable. So what that tells you is once it comes into an automated process, particularly if there's machine learning involved, is that black box that you tested when you bought it is not going to stay the same from the minute you turn it on, because a learning machine allows it to change its programming. And that's called, in my mind, model risk. So I haven't come up with any really great ideas about what to do about that, except that I think that, especially if you've got processes, they're moving so fast. It's like, it's multiples the time of anything that we've seen in the past. It's pulling data and information and decisioning from so many different places. It's very complicated. So what I would highly recommend you do is actually think about bringing in some other model builders to test your applications on a regular basis to see if the outputs are matching what you think that they should be, because you will not be able to test these things, and it's not a once and done. This really is continuous monitoring of risk on the model risk side. So I think that, getting back to, now that we've got a better sort of understanding of the foundations, and we thought at the beginning about communicating with your organization, your board, your senior management, and your business leaders, you really need to think about how to better engage your senior management. Because I do hear people say that, they talk to their senior management and it's kind of yeah. First of all, I'd like to tell you, if you have a good data, when you first go in with the first data with good data, the first time you've ever produced the data on, the critical third parties, what they're doing for you, what the risk profiles look like for individual relationships, for businesses, for types of risks. This is new news for the organization. They have never seen this before. And I have to say, my own personal experience with people right up to the top of the house is they meet it with some trepidation. So just be mindful of that it's information they've never seen before, and it's a bit scary knowing that it's all to be revealed. But once you get that level of engagement, it's really keeping it then and helping to advance your organization and to make it stronger by having better risk management practices. So we'd like to think about, well, what goes to the board today? So this is an eye test. I thought we actually put this into 3 slides. Let me just check and see. So yeah, okay, so for the smaller organizations, so race community banks and put sort of any organization, the methodologies for determining what's critical and how you got to risk, these slides will be available, by the way, how you got there are things that your board actually should be more involved with. It's kind of it's not something that they want us to spend a lot of time on, but you want to give some assurances directly or through your risk organization around the methodologies. And I have to say that I've always resisted that risk identification process. I didn't want it to be a model because then I have to go through model risk testing. That was my old thinking. I think my new thinking is a little more up to date on this. But the methodologies for understanding how it's determined is really an important thing for your board to know. And then also another thing is that if in fact they're responsible for the strategy and the strategic direction of your organization, why do they not know how you're planning to use these relationships to advance or to run your business? I think that that's a very critical thing as well, that they have advanced warning and they're aware you're getting in or out of major relationships, what the risk profile looks like, and what they're going to be doing for your organization. And so, they are seeing a lot of information around ongoing monitoring and also the results of, these periodic or independent audits of the program itself. But I will say that there is no mature program out there. And in the third-party risk management survey that we do, every year, everybody says we're going to be mature within a year. I would have to say maybe 5 more, because we're still stuck in activities, right? We're still having problems getting our due diligence, back from our third parties. We don't know if we're asking the right questions. We don't have predictive analytics. We're not really managing risks in a very proactive way yet. We're really very much in the prevention side of things as opposed to the detection side of things. And so that's what comes with predictive modeling. Because if you take a point-in-time perspective on third-party risk, it's not nearly as powerful as being able to refresh that and start to look ahead with a changing environment. So if you listen to the panel discussion just after lunch, that's really what they were talking about, is how do you get ahead of that using technology so it's not a once and done or once every 3 years. So when you start to get up into the other organizations, we're seeing that once again, these things are very low, and most of the focus in the mid-tier banks, which is pretty big-sized companies, 20,000, 50,000 employees, they're still focused very much on the monitoring and the results of an audit. And I don't think that that's the point. I still don't think that's the point. And in the large banks, basically, you're seeing more engagement, and I think it's because the larger banks have been in more trouble over this. You look at, every now and again I co-present with a fellow from Wells Fargo. Well, they're under so much pressure that, you know, the amount of detail they get into, it's a little hard to tell if you can see the forest for the trees, because they're into extreme detail on how it works, and then basically trying to report back on that and trying to manage it is taking a lot of resources, and it's hard to say if it's actually improving the business. So this is what I think that your boards and your senior management should be informed about. And I don't think we're close to this. I've never seen any instance of this in an organization. And if you're already doing this, I'd like to hear from you, because I'd like to hear about your best practices, because I'm involved in so many industry organizations. I'd like to help you perpetuate them. But the methodologies, controls, and results, I think that's kind of a background information. It's not that it's unimportant. It's just that it shouldn't be the primary message. What I think is most important is helping your board and your senior management understand the ecosystem that you operate within. You have your internal operations, you have your own employees, etc. But the volume and the complexity of the third-party relationships and how they interrelate with their third parties and their third parties and their third parties is extremely complicated. So I think that trying to get a better view of the world, of where you fit. You know, your company's not the center of the universe, no matter how much you might want to think it is. You're part of a larger universe, so it's important to see where you fit. So I think if I asked for a show of hands around what companies in the room are using AWS, every hand would go up. It's an interesting question, right? So what happens if AWS actually has a serious problem, because they're the largest cloud provider around, as far as I know. So we're all relying on those great controls that they have. But I think if you can see the ecosystem and understand where you fit in the larger whole, what you should really be feeding back to your board and your senior management, what I'd like to know if I was sitting in the board seat, is how does all this relate back to my corporate strategy that we as a board have approved, that you as senior management are implementing and overseeing and providing governance on a day-to-day basis and managing? How are you communicating all of this through tone at the top? Most of the companies that I know who are third parties don't really understand what it's all about. All they know is that they have to fill in all this due diligence, and it's really actually draining a lot of resources. Most of the third parties that I deal with, they don't really understand what it takes in order to be a good manager of their third parties and their third parties. So I think that helping them understand why you're asking these things and how it fits is important from a programmatic perspective. But I think you need to be able to feed that back to your executive management and say, now that I know how they fit with our corporate strategy, whether or not they understand our tone at the top, our risk culture, our risk controls, and our expectations beyond what we're trying to hammer into a contract, and how they fit or could help us meet and stay within our risk appetite, that's a way better conversation. And I think that we would eventually get there, but not if we don't think about what it could possibly be. And if, in fact, we can do these things well, what it will do is have a positive impact on your customers, because you will be protecting them. Because they actually do care if it affects them. They do care, and they will vote with their feet, or they will punish you in other ways. Because those breaches or those failures, etc., I mean, how many times have you tried to actually, get online and you can't, or you expect a service and you're not getting it? I mean, it's really frustrating. I bought a car last week. I don't understand why all the paperwork was wrong, so it took 2 hours to fix. Stuff like that. You have expectations as a customer, and in this case, we're talking about risk and protections. So what that does actually is affect your brand. We all talk about reputation risk. And reputation risk today in most organizations is, in their third-party risk management program, it's a question, if something went wrong, how many customers would we affect? If something went wrong, how many people would know? How widespread would this negative news be? That's not what your brand is all about. Your brand is all about the value and the goodness in your good name. And so your job is to protect that good name in every way possible. So how do your third parties help you do that? Do they understand your brand? Because it's tied to all those things that are above it. So your brand actually has a value, and I think where we're going to go is, in fact, I'm working with a small group of people. We're trying to create a quantitative model to determine the value of your brand and the damage that you can do to it through a problematic third-party relationship or a serious incident or breach. Because there should be enough data out there for us to come up with a fairly simple model to say, is it really worth investing in third-party risk management and protecting our brand with a quantitative measure? I mean, even in the book I postulate, shouldn't third parties actually be, in some cases, on your balance sheet? If they are that important, I mean, I've been judging Outsourcing Excellence Award for years. There are some relationships that are so inseparable from your company that you couldn't survive if, in fact, they were extracted. And it's not just because you have services, it's because you innovate together, you invest together. You're actually pushing the market forward together. And so those, I think, actually could go on your balance sheet because accounting rules will actually allow for it. It's just not done today. And if it's on your balance sheet, don't you think it would get a lot of attention? Because that would make a big difference if the value was being eroded in some way, because you would have to financially account for it in your financial statements. And of course, the impact on your shareholders, there's nothing like a good news story to have your share price go up and your shareholders be happy and your company more attractive, which gives you more money to spend on all this stuff. So I hope you agree with me. This is what your board and senior management needs, not all that stuff that we saw a couple of minutes ago, but you need all the the tools and the processes and the data to get to a place where this works. But the other thing that's missing is good communication. You really need to have good conversations and find a way to communicate with the third parties that you do business with so they understand where they fit into this equation to help you push your company forward. So when you think about it, basically, management is doing things right and leadership is doing the right things. And I would say that you actually have to have both of them to have a successful company. So it's just kind of food for thought. So I'm gonna park it here, but what I would like to do is, if you happen to work with any of these people, when I wrote the book, I have to say I had two very, very important gifts. One was Christelle Bilodeau, who I dedicated the book to, happened to be off on a high-risk mat leave at the time, and she phoned me and said, I need some brain food, do you have anything to do? So I had a sounding board for everything that I wrote. She is a senior executive in a central bank. And so I asked her to read the stuff and give me feedback. So that was a gift. If you ever write a book, find Christelle, because otherwise you're writing into an empty well and you don't know if it's any good. But the other thing is that the people on this list were incredibly important to me, because when I wrote a chapter, when I read the whole book, I looked at the chapters and thought, who do I know? I mean, I'm a great networker. And so I reached out to people and I said, listen, could you please read this chapter? Tell me, A, is there anything wrong? Right? Because you're an expert in model risk, or you're a CRO or whatever. Is there anything wrong? Did I miss anything important? And what do you think on the topic? So these people they made a huge contribution and made me feel comfortable that the book actually has a huge amount of substance. So anyhow, I'm going to stop there and take some questions. We have about 10 minutes.
Get your insight on that, and where could they go right?
That's a good question, because one of the places where I've seen that could cause you a lot of grief in the long run is figuring out how you're going to calculate the quantity of risk, right? So if your methodologies for determining risk ratings is wrong, and you have a composition of risks that are not making a whole lot of sense. So I think I might have mentioned that one of my clients, when I've looked at their program, their information security component of it, everything was weighted equally, and it covered a lot of ground. And so, but they're not all equal. And that means that all of those risk assessments that they've done, in fact, they're gonna have to go back, after they fix this, they're gonna have to go back and redo it. And I had that experience myself where I looked at the risk rating and I thought, you have got to be kidding me. Because it started, like I didn't know it was wrong because I really didn't look at it. But it started spewing out some really weird results. So one of my own relationships that I was responsible for as a corporate executive was showing up as a high risk. And I thought, but it's not. I've been de-risking by shrinking the relationship. And so I'd actually started pulling services away that I was not comfortable with. And how did it get to be a high risk? It was because the methodology for determining the risk level was pretty crazy. So it was giving 50% of the marks on risk for whether or not you thought there were going to be a lot of changes coming. Well, of course I said, yes, there's lots of change coming because I'm shrinking the relationship. And so, you know, and so then when I start looking at them, they're like, they were all wrong. They were all wrong. And because, you know, that was the first time we ever had done really good risk reporting. And that was the first batch out. I wanted to see what my own organization looked like. And I thought, oh no, we're in trouble. So I had to go tell my boss, hey, we're going to have to run all of these again. And we had 2,000. We had to redo the risk ratings on 2,000 of them because they were wrong. And so if you don't understand the risk from the first place, then everything after that's going to be wrong. Your controls are going to be wrong. The amount of work effort you put into it's going to be too much or too little. You're going to end up, you know, over or under monitoring. And so if you have anything, you know, really have a very close look at how you're actually determining the scoring on your risk model, because everything else after that, if that's wrong, everything's going to be wrong. No more questions?